Welcome to vTalkInsight, Market Drivers Daily for July 7th, 2026. Geopolitics, AI, capital spending, and shifting market leadership are colliding today as fresh energy shocks, a massive AI buildout, and one of the sharpest momentum reversals in years reshape the opportunity set. Let's look at how the Hormuz disruptions, hyperscaler bond issuance, and quiet but powerful factor rotations are feeding into inflation, yields, and cross-asset positioning. Geopolitics and energy are back at the center of the macro picture, as the Strait of Hormuz once again proves to be a key choke point. A Qatari liquefied natural gas carrier and other vessels have been attacked near Hormuz, prompting ships to reroute or pause and keeping overall traffic below pre-conflict levels. Oil benchmarks such as Brent and WTI have bounced, while European gas prices jumped over 5% on the latest incident, reinforcing a risk premium that had started to fade only a few days ago. Beneath those headline moves, the oil complex is sending mixed signals that matter for inflation and sector performance. On one side, Saudi Arabia has cut prices to Asian buyers and OPEC Plus has raised production, while surplus crude from the United States and Canada is projected to reach around 9 million barrels per day next year, all pointing toward oversupply pressure on crude. On the other, refined products tell a tighter story. Russian refinery outages from Ukrainian strikes have removed over 1 million barrels per day of output. Diesel prices are trading near double the price of crude, and margins for refiners look exceptionally strong. The combination of shipping risk and refined product tightness is feeding directly into the inflation narrative. High diesel and gasoline prices lift freight and transport costs, and together with earlier Hormuz-related shocks, have helped push headline inflation higher, with recent readings moving from the mid-2% range closer to just above 4%. Bond markets are starting to respond. European yields have edged up on renewed inflation worries, and in the United States, 10-year Treasury yields have risen a few basis points alongside higher Brent, even as other forces such as heavy corporate supply also play a role. At the same time, Europe is embarking on a structural rearmament that could reshape its fiscal and sector landscape. NATO allies have agreed to significantly increase defense spending, with targets around 5% of GDP by the next decade and about 3.5% earmarked for hardware and ammunition. New commitments include roughly $50 billion of fresh defense industry deals split between European and U.S. providers, while countries such as Germany and Italy plan large multi-year boosts to security budgets. This points to sustained demand for defense contractors, but also raises questions about sovereign debt trajectories and the possibility that investors demand higher yields to absorb larger fiscal deficits. Ukraine remains a central catalyst for this spending shift and a key source of medium-term risk. Kyiv has reclaimed territory and used long-range strikes to disrupt a large share of Russian oil refining capacity, yet faces acute shortages in air defenses, prompting NATO discussions about licensing Patriot missile production on Ukrainian soil. European leaders are also increasingly focused on hybrid threats, such as cyber attacks and sabotage of undersea cables and pipelines, which is driving investment in underwater technology and critical infrastructure protection. For markets, baseline expectations still see low odds of a direct U.S.-Iran clash or a sudden change in global order from the current NATO summit. But the combination of a persistent energy risk premium and structurally higher defense outlays keeps an upward bias on inflation and term premia. With that backdrop, attention turns to how the AI investment cycle interacts with this new geopolitical regime. The AI story is evolving from a pure growth narrative into a macro and credit regime shift as capital spending scales to historic levels. AI-related infrastructure investment in the United States is projected to approach $1 trillion next year and roughly $1.5 trillion by 2030, with data center and energy projects already contributing about 0.7 percentage points to this year's roughly 2% GDP growth. Large tech platforms are financing this build-out aggressively. Amazon, for example, is raising around $25 billion via a multi-tranche, long-dated bond deal to fund AI expansion, part of a broader wave of hyperscalers tapping fixed-rate debt markets. This investment boom is supportive for growth, but introduces new inflation and credit dynamics. Capex tied to AI is outpacing revenue growth at some large tech firms as they rush to secure data center capacity despite elevated valuations. construction labor, power costs, and memory prices are rising, and supply bottlenecks in high-bandwidth memory and related hardware show little sign of easing before the end of the decade, making the cycle more inflationary than early deflationary narratives suggested. Financing structures add another layer of risk. Vendor financing is helping support hardware demand. Secondary markets for GPUs are emerging as some customers resell kit, and there are concerns that capital markets capacity is being stretched, potentially widening credit spreads for non-AI sectors that now compete for funding. Equity markets are already repricing parts of the AI complex as this capex wave meets lofty expectations. Samsung just reported a 19-fold surge in quarterly profit on strong AI memory demand, yet its shares fell sharply, dragging the broader semiconductor index lower and contributing to underperformance in global chip names. European technology heavyweights such as ASML and Infineon are down meaningfully, and European AI-related equities are seeing renewed selling pressure despite solid earnings, signaling valuation fatigue and a shift away from blanket chip exposure. At the same time, leadership within tech is rotating. Investors are gravitating toward hyperscalers and previously lagging giants, whose forward earnings multiples have reset, while still counting on structurally strong demand for high-bandwidth memory and data center infrastructure. Beyond markets, AI is starting to leave a clearer footprint in the real economy, though its ultimate productivity impact remains uncertain. Usage of AI-driven therapy tools in mental health has more than doubled in a year, from roughly 5% to 11% of users, and industry players are beginning to publish benchmarks for ethical and responsible AI deployment. AI is also accelerating pharmaceutical and medical research timelines from a decade toward 3 to 5 years in some cases, while AI-related spending on data centers and energy infrastructure is adding measurably to jobs and GDP. Despite early fears of mass layoffs, demand for software developers remains robust, consistent with historical patterns where new technologies create at least as many roles as they disrupt. Even as prominent economists caution that productivity gains may fall short of the most optimistic forecasts. Geopolitics and market structure are amplifying the risks around this theme. Export controls on advanced chips have pushed Chinese firms to accelerate their own silicon development, with players such as DeepSeek working on custom AI hardware to reduce reliance on NVIDIA and other incumbents. Even so, NVIDIA retains a near monopoly in cutting-edge AI compute, and the chip sector now accounts for a large share of major U.S. equity indices, making it a focal point for any escalation in U.S.-China tensions. Across equities, credit, and private markets, exposure to AI has become a single-factor risk, as valuations in some names embed very long-dated revenue projections based on a limited set of contracts. Yet the underlying message from today's flow and earnings signals is that the AI capex cycle remains in its early stages, with sustained demand for memory, infrastructure, and related services likely to keep the theme central to macro and portfolio discussions. That sets the stage for the third key driver: how leadership is shifting beneath relatively calm headline indices. Headline indices may look orderly, but beneath the surface, this is one of the most rotational markets in years. Index-level volatility is subdued, and there is little sign of heavy hedging demand in broad options markets. Yet implied volatility for sectors, such as semiconductors and for individual stocks, is historically elevated. An implied correlation across the S&P 500 has dropped toward record lows. Recent semiconductor weakness following Samsung's results has dragged the Nasdaq lower and left European tech sharply underperforming, even as European equities overall show limited movement and some defensive appeal versus more volatile Asian markets. At the same time, leadership is broadening beyond the narrow group of megacap AI winners that drove earlier gains. Small caps have staged a notable rebound, with the Russell 2000 up around 20% year-to-date and outperforming on days when large-cap tech falls, while equal-weighted indices and a wide swath of S&P 500 constituents show double-digit gains. Defensive and income-oriented sectors including energy, utilities, consumer staples, and insurance form a historically large cohort of stocks, moving inversely to the S&P 500 as investors look for diversification away from AI-heavy indices. Emerging markets, especially those with less direct exposure to the AI trade and cheaper valuations, such as parts of Latin America, have also been seen as attractive alternatives. even though flows are now slowing as some capital rotates back toward U.S. large caps. Factor behavior reinforces the sense that the previous regime is being tested. Momentum strategies have suffered sharp drawdowns, with high-profile baskets down roughly a quarter from their peaks, marking the largest setback in several years and signaling that chasing past winners has become more hazardous. In contrast, diversification across styles has been rewarded, and multi-strategy hedge funds have delivered steady, if unspectacular, returns thanks to their risk management rather than directional bets. Options positioning shows hedging concentrated in small caps, where investors are keen to protect recent gains, while the tech sector, despite its volatility, exhibits relatively muted demand for broad downside protection, suggesting that many still see the current phase as rotation rather than systemic stress. Looking ahead, the key question is whether this high dispersion regime endures or fades back into a familiar pattern of narrow leadership. Small caps have seen their AI infrastructure exposure reduced following recent index rebalances, which could moderate future outperformance, and some flows are already gravitating back toward higher quality U.S. large caps. On the other hand, Europe could gain relative support in the second half if geopolitical risks ease at the margin and sector rotation continues beyond U.S. technology, particularly given strong order books in energy and defense. For portfolios, today's backdrop argues for close attention to factor and sector exposures, liquidity in crowded AI trades, and the potential for further sharp swings between growth, value, and defensive segments as economic data and earnings guide the next leg. To wrap up, today's moves underline how a renewed Hormuz risk premium and accelerating European defense spending are keeping an inflation floor in place and nudging yields higher, even as oil markets juggle crude oversupply with tight refined products. At the same time, an unprecedented AI capital spending wave is driving growth, lifting bond issuance, and challenging equity valuations, particularly in chips, while the broader theme continues to diffuse into healthcare, infrastructure, and credit. Equity leadership is no longer a one-way AI momentum story. Breadth is improving, momentum factors are under strain, and dispersion is putting more weight on stock and sector selection than on simple index exposure. Against that backdrop, monitoring energy choke points, sovereign funding needs, AI capex guidance, and the persistence of factor and regional rotations will be critical for understanding how risk and return trade-offs evolve from here. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.